Welcome to the Genghis Weekly Investor Briefing. In this briefing, we take you through the key events in the finance sector for the past week and also give you an update of what to look for in your investment in this coming week. And today we are privileged to have our head of research, Churchill Ogutu, who is back from a sabbatical, he will be flanked by Melody Ndanu and Wesley Manambo, who have been holding fort while he was away. And welcome back, Churchill. And I think it will be prudent to start with you today.
Thanks, Dan.
Before you continue, maybe some housekeeping rules. Should you have a question, kindly direct it in the Q&A section and it will be answered after the presentation. And while at it, you can also raise your hand should you want to ask your question live, and we'll give you a chance once the Q&A session starts. Thank you very much, and over to you, Churchill.
Thanks, Dan. Good morning, everyone on the call. Happy to be back. So let's just start it off. Okay, as usual, we'll start it off with looking at the macro review and getting onto the fixed income segment. So a review that came out last week. We do have sorry, screen not moving. Okay, yes. We had some updates that were given by the Central Bank of Kenya during its in its weekly bulletin. Starting with the public debt, they gave us some statistics in regards to the public debt, where it was as at the end of June, basically as at the end of the last financial year. So it came to 7.71 trillion, which is basically what was expected at the start of the financial year. So this statistics is well in the targets that even Treasury had for the last financial year. So in terms of the split between domestic and external, domestic is at 3.7 trillion, so that's roughly 49% of the overall public debt stock, whereas for the external debt is around 4 trillion, which is around 52.9% of the overall stock of public debt. Basically, so we just did some quick calculation and just looking at what was the net increase in public debt during the month of June. So for domestic debt, that was just an increase of 10 billion, whereas for external debt, that was an increase of 317.6 billion. Obviously, this was on account of the Eurobond, the 100 billion shillings, the 109 billion shillings that came in. There was that World Bank loan, another 82 billion. And then there was, which other loan came in? There's the one for IMF loan, and then the bilateral loan. So all these came in the course of a single month, 318 billion, thereabout. Whereas for net domestic borrowing, what we've been talking about, and even the statistics that we showed you over the last couple of weeks, the rejection of T-bills, and even the on the T-bonds, at least for the month of June, there was some healthy uptick, but now it was offset by the rejection of T-bills against the maturities of that. So the net increase in domestic borrowing in the month of June was 10 billion shillings. So point is, external financing flows came in handy, in huge flows during that particular month of June. So what we'll be asking ourselves, and the answers will be out sometime this week, is how quickly were these external financial flows disbursed to terms to the budget expenditure? Because on one hand, as you think about it, the financing is now geared towards plugging the budget expenditure hole. So that will be answered at some point this week when you look at the statistics. Should they be released this week of the net expenditure for the month of June. So that will be something worthwhile keeping an eye on. The second metric was now on diaspora remittance for the month of June. The statistics that came there was around $306 million came in vis-a-vis $316 million in the previous month. So that was a slight decline month-on-month basis. So cumulatively for the last 12 months, we've seen that it's been $3.4 billion in terms of diaspora remittance, and that is an increase of 20% year on year in terms of the cumulative diaspora remittance the last 12 months vis-a-vis a comparable period the previous year. So some quick thinking around diaspora remittance that basically offsets the decline in the current account. So if you think about the current account deficit or surplus, because Kenya is a net importer nation, we are running a current account deficit because our imports are greater than exports. So that by itself tells us we are running a trade deficit. I think the last number you saw, it was, I think, 1.1 trillion shillings. So if we 1.1 trillion shillings, at least for the last 12 months. I think the start was at April. So if we look at now diaspora remittance, $3.4 billion, which is roughly 340 billion shillings. So it offsets that trade deficit, and then it comes to something much more meaningful to around that $1.1 trillion, 1.1 trillion shillings is now reduced to something 600 billion shillings. And that is where you hear current account deficit as a percentage of GDP is around 5.5%. So basically you're comparing something in the order of 600 billion shillings against nominal GDP of 11 trillion shillings. So that's where the 5.5% is coming along. That said, we still don't have data for trade deficits up until June. We don't have the nominal GDP data. So we are still relying on the preliminary data that CBK gave us the previous week, that the current account deficit is at 5.5%. So that's just my quick comments around those numbers, but clearly at 20.4% year-on-year increase, that has exceeded even the expectations that were there at the start of this COVID-19 pandemic, whereby diaspora remittance were expected to slump just because of the hit on the source nations in terms of the flows that were expected to come to Kenya. So another statistics that I forgot to mention is now there's this private sector credit growth. For the month of May, we did a quick estimate calculation just based on the data that CBK gave over the course of last week. That came to around 7.1%. So that was an increase in the month of May from the 6.8% that was there in the month of April. So that is part and parcel of the M3 money supply statistics that CBK gave out in the course of last week. So just that we didn't put it in our chart for this presentation. So for this week, we're expecting this net revenue and expenditure as at June 2021 should be in this Friday's Kenya Gazette issue. So basically just giving us how the disbursements over the course of the whole of last financial year, whether Treasury was able to quickly disburse these amounts of monies. So it will be quite interesting, and I'll be particularly interested in how quickly this 316 billion was quickly deployed, be it to the MDAs, be it even servicing the public debt. I know at some point there's some county allocation. At some point it was in between the month of June, we are running a number of around 70% had already been disbursed. So the other 30% hadn't been disbursed. I think up until the final 2 weeks of the last month. So then this report will give us some highlight snippets on what were the overall disbursements in last year's budget. So that's something quite worthwhile watching out, and then we'll give out topical notes in regards to that area. So quickly moving on to the fixed income, T-bonds, last week secondary market activity bounced back 15.5% week on week to 224.4 billion shillings. Most of the trades basically on the infrastructure bonds and also between the short to the medium part of the yield curve. So you're looking at activity between 2 years all the way to 10 years, 12 years in terms of their life to maturity. So those are the papers that are on high demand by investors at the moment. T-bills had overall performance rate of 80%. So in aggregate terms, that was 19 billion bids that were received. So this is the first underperformance in T-bills in 11 weekly auctions. It's quite telling, but of course, against the backdrop of the bond that was issued, it kind of makes sense, this underperformance in T-bills, as most investors now preferred to get into the T-bonds as opposed to look at the T-bills. And besides, we've seen that there's been a retreat in T-bill yields. On average, since the May 2021 peak levels, we've seen an average decline of negative 1.17%. Obviously, the decline has been more pronounced on the 182-day T-bill and the 364-day T-bill, but nonetheless, on average, we're looking at an overall decline, an average decline of negative 1.17% from their levels in the month of May. And to be exact, as at the end of last week, 91-day T-bill and 182-day T-bills were below the central bank rate. That's at 7%. So at 91-day T-bill is around 6.5%, whereas 182-day T-bill is around 6.9%. Obviously, there's some nuances around this. Will it now lead to the CBK now either increasing its rates, its benchmark rate, or reducing its rates? Though we are of the opinion that this decline or the yields below the central bank rate is quite temporary, where as liquidity normalizes, we'll now see yields now starting to chart an uptrend. That's our expectations for third quarter. So sometime either end of this month or as we get into the month of August, we're likely to see that yields, as we see normalcy in liquidity, yields will also now start to chart an uptrend. So that's our expectation. So we are seeing that this below 7% in the 91-day T-bill and the 182-day T-bill is quite transitory. It's something that is fleeting. So in terms of liquidity, last week, the average interbank rate saw a decline of negative 0.59% to an average of 4.08%. So that's what panned out over the course of last week. The volumes also came down. So basically what this interbank data is telegraphing to the market is, well, there's that element of high liquidity, which has now pushed interbank rate lower. And also they turned the switch into a new CRR cycle. Remember, the cash reserve ratio cycle starts from the 15th every month up to the 14th of the following month. So that switch started last week. And with the switch, usually what happens, what you've noticed, the interbank goes down a bit as now bank starts to adhere to the previous CRR, or what's the CRR ratios that they're supposed to have. So that might also be a function to the reduction in the average interbank over the course of last week. But that said, looking at the open market operation, so basically on a daily basis, CBK comes and assesses how liquid is the banking sector. If it's liquid, so they have to mop up the excess liquidity. If liquidity is below a target level, they have to inject liquidity. So over the course of last week, they assessed that there was excess liquidity in every single session. So they had to mop up the excess liquidity through what an instrument called the term auction deposits. And the tenor that was specifically used was the 7-day. So the 7-day term auction deposits. So the bids that were received was 92.3 billion. Bids that were accepted was 90.3 billion at a weighted average rate of 5.286%. So that just tells you how liquid the banking sector was during the course of last week. And that also was a function to the primary bond auction that we'll be talking about in the next slide. So our calculation of the net domestic borrowing, so basically the government securities, T-bills and T-bonds, our calculation as that so far is at 24.3 billion. Financial year started 1st of July. So all the T-bills and T-bonds that have been achieved or have been attained through the government borrowing. So it has totaled to 94.3 billion, and that's inclusive of the CBK overdraft facility. So domestic borrowing as a target of the current financial year, which is 658.5 billion. So far we're at 14.3%. So it's pretty much decent, ideally above or ahead of the curve if you prorated this 658.5 billion, prorated on a monthly basis. So I think at this moment we're way ahead of the curve, and that is basically on account of this issue, the July primary bond, where the government CBK was seeking 60 billion. CBK here is the fiscal agent. Amounts that were received was 116.9 billion shillings, of which the amounts that were accepted was 79.9 billion. So a quick thing I can mention here, and it's something that is usually not obvious or is not explicit in the primary bond auction. If the CBK announces that it's targeting 60 billion, and then most cases, if you go back to the T-bonds that we've seen some healthy subscription, we had that one for the April IFB, which was quite healthy, but yet the amount that was accepted was over and above the amount was the offer rate. So that difference is what we call the green shoe option. So clearly, for this particular issue, we could just adduce that the green shoe option was 20 billion for them now to accept something in the order of 79.9 billion. So the offer amount is 60 billion, green shoe option of another 20 billion for each now to accept 8 billion. And then another, just to contextualize it, because the value date of this July primary bond is actually today, whereby if you are an investor who had invested in these bonds, so you are expected to have remitted your monies by today. So today is the value date before it starts secondary trading tomorrow. And then today actually is also the maturity of a 5-year paper, an initial 5-year paper that was issued in 2016. So FXB2 2016-5 is maturing today. It has an outstanding amount of 24.4 billion. So it's clear that even the amount that was accepted over and above the offer rate was now to partly retire this maturing date. So if you net it off, 79.9 billion minus 24.4 billion that is maturing today, you have a net domestic borrowing of around 55 billion just from this issue that we are seeing. So those are down there. I can clearly see that the weighted average rate was above the coupon rate, but the aspect that we are seeing here was that accrued portion, accrued interest on the bonds. So that is what the data price you're seeing, that is for every 100 shillings that you have, you end up paying as an investor. Perhaps if you want to come into the secondary market at this pricing for the primary, the column at the very end is giving you the indicative amount that you could enter into these particular papers. That said, once the value date is, since the value date is today, the secondary market will now start in earnest tomorrow once these monies have been collated together. So getting on to the big spread, we have a buy on the FX1 2012-15. So this is one of the papers that was in last week's primary bond auction, the first one to be sure, where the bids that came in was 48.8 billion, but the CBK rather accepted 30.1 billion. So we are seeing 18.7 billion was rejected for this particular paper. So, and what the overarching theme that we've seen over the course of the last couple of weeks is that there's high liquidity. And because of the high liquidity that we're seeing in the market, most of the investors or most of the institutional investors will likely look at the opportunities at the short end of the yield curve, basically maturities below 5 years. So those are the papers that are flying off the shelf at the moment from an institutional investor's perspective. So that is what our thinking is, looking at the FXD1 2012-15, and because of these rejected amounts that were rejected bids, so most of these investors who missed out on the primary will now try and seek entry opportunities at the secondary market. So we're looking at between 11.4% to 11.5%. That said, there are a number of other opportunities, but this is the one that is sticking out as a sore thumb for this big recommendation. Let me stop there. And then we get to the equities. Melody, will you share your screen or I continue sharing my screen?
Kindly share yours. Mine is having a bit of a problem sharing.
Okay, cool.
Thank you.
Good morning to you. The market was bullish over the past week as reflected by the uptick in the benchmark indices, NASI by 2% and NSE 20 by 1.1%. Crown Paints registered a 10% drop in price on the back of its rights issue that started trading on Thursday. The downward price adjustment reflects the additional new shares from the issue that successfully raised 809.6 million from the issue of 80.96 million new shares that are now trading on an equal footing in all respects to the existing shares. The counter shared the counter share price has dwindled over the past 3 weeks. The week ended 2nd, it shared 10.25% to earn a spot as the top loser, and in the week that the past week before this, it shared 26.74% on the closure of 9th at 26.3 shillings. On foreign participation, foreign investors exerted their dominance, accounting for 57.5% of the week's turnover. They accumulated across the key stocks to clock net inflows of 108.12 million, mostly bullish on Safaricom, Equity and KCB, while exiting on EABL and BAT Kenya. On peer review, we had the Nairobi All Share Index outperform its peers on a weekly median of 0. Its price to earning ratio and year to date was above its African median of 10.3 and 11.3 and 11.1%. However, its dividend yield was below its African median of 5.3.
Sorry, Wesley, I continue?
Yes.
Okay, so for the banking sector, or rather the financial sector, we've seen that equity group holdings closed marginally lower at 48.55 from the week's open at 49. KCB also followed the same trend, closing at 44.85 down from 45.5 at the start of the week. The rest of the counters have been relatively stable, and DTB, however, witnessed an uptick from an open of 59 to close at 66.25. So one of the developments was that CBK is proposing a return of CRB listing of digital loans. So it's proposing a revision of the CBK Amendment Bill 2021 to allow lenders to resume reporting customer loan defaults to CRBs, which is credit reference bureaus. So digital lenders were ordered to stop filing with CRBs in April last year because the regulator was responding to the accusations of widespread abuse of this profiling system. So it locked out some digital lenders and credit-only providers from sharing information. And it retained 39 banks, 14 microfinance banks, 1,353 unregulated SACCOs, 164 regulated SACCOs to continue sharing information. So this bill has been, it proposes a 6-month grace period from the time it comes into effect, so that now digital lenders need to register with the CBK. So secondly, Standard Chartered, it launched a carbon dated report that shows that 78% of multinational companies will remove some suppliers that endanger their carbon transition plan. So we've seen there's been a lot of move to environmental friendly energy sources, and they say that if Kenya faces losing up to 3.9 billion shillings if it doesn't speed up its pace in this decarbonization agenda. So it was also noted that one of the dailies reported that the Standard Chartered Bank is planning to introduce green mortgage financing so that it can leverage on sustainability financing gaps that are there for revenue growth. So this program will target property contractors that either conserve water, reduce waste, or use renewable power sources like solar energy. So the bank was suggesting that government should set up regulations on clear standards of what a green building actually is. And lastly, Egypt's bank Misr is planning to come into the Kenyan market. This will be the second lender after we saw the CIB Bank from Egypt, Commercial International Bank, which acquired a tier 3 bank called Mayfair Bank earlier last year. So Kenya has seen a renewed interest in global banks after the CBK lifted the moratorium in 2017 last year, and we saw many foreign banks acquiring smaller local banks. So the Kenya National Chamber of Commerce and Industry has started talks to revive a framework for strengthening bilateral trade between Egypt and Kenya. So this can see some trade finance inflows coming in, and that's why they're positioning themselves in the Kenyan market. So for the trade of the week, we had a hold on, excuse me, we had a hold on Equity Group because this counter has been trading closely to its 12-month high, and income-oriented investors who are anticipating dividends can anticipate them because the shareholders adopted a dividend policy in its latest AGM to pay out 30 to 50% of its profit after tax. So the group is also betting on enhanced cost efficiencies from the growth of its non-funded income as it shifts from third-party variable cost channels to self-service, from variable, let me say that again, they're shifting to third-party variable channels and self-service performance platforms. Back to you, Churchill.
Thanks. I think that marks the end of our presentation. So back to you, Dan.
Thank you very much, Churchill, Wesley, and Melody. Now we go to the Q&A section, and we have one question from Elvis Ayara, who is asking, can I buy shares on Flametree? I don't know whether we cover Flametree.
Unfortunately, we don't actively cover Flametree, but something we can be able to look into, but we don't cover Flametree as much. Yeah. So we'll not be best placed to give a recommendation at the moment.
Okay, Nelco Mose is asking, what's your stock pick of the week? Melody, you had highlighted this, so maybe you can once again repeat it for Nelco to hear.
So our stock of the week was equity. We had a whole recommendation on it because we saw that the shareholders had earlier adopted a dividend policy to pay out 30 to 50% of its profit after tax. We know that the previous 2 years, equity hadn't paid dividends because of the coronavirus pandemic. So now at least investors have that assurance that the policy has been formalized to pay out dividends. Also, we've seen that the non-funded income has been growing because of the digital initiatives, and now they're moving to third-party variable cost channels as well as self-service platforms, which will reduce costs and also boost their non-funded income.
Okay, thank you very much, Melody. Nel Komose is also adding on another question. If it's equity, why not KCB, looking at the fact that it's lower, but its share price is lower than equity is by 4 shillings. The two are correlated, or rather, are the two correlated?
So I think we had suggested last week for holds as well on KCB. So both of them usually are correlated. So this one was just to look at the investors who are like the previous period had not gotten dividends, but now because of the approved dividend policy from the shareholders, now they can look up to that option as they hold on to the equity counter.
Okay, we have a question from Facebook Live. We also stream this webinar on Facebook Live, so should you maybe miss it here on Zoom, you can check it on our page. So Johnny Delgado is asking, inform me about the price rally of TransCentury, CIC, and Scan Group. Maybe I repeat it. Johnny Delgado is asking, inform me about the price rally of 1, TransCentury, 2, CIC, and Scan Group.
As my colleagues think of other answers, perhaps I can just give it. It could be investors buying the dips. If you think about the different names that the particular investors mentioned, TransCentury recently they came up with that, the approval for the rights issue. Remember, it's still in the red in terms of the last numbers that we saw, that is as at full year 2019. We still haven't gotten the numbers for full year 2020. But that said, there's that AGM that they had for full year 2019, where they had an approval for a rights issue to have some new additional 2 billion new shares. So that is the latest event we've seen. For Scan Group, they proposed, they extended, there was an extension on its financial statements to be released. The delay was occasioned by the investigations from the previous C-suite managers, that's the CEO and the CFO. So that is what now, that was their request to the CMA for an extension of the release of their publications. This is for full year 2020, which you haven't seen. So for those two counters that stand out, you haven't seen anything that could now warrant a price rally. But it's just investors just taking opportunities at these price levels on those particular counters, and that perhaps led to the rally. But on a more fundamental basis, we haven't seen anything from a fundamental basis, that is, we haven't seen any news events that could now lead to the substantial rally that we saw, but it's just the buying the dips by some of the investors taking opportunities. Don't know whether Wes or Melody have some other additional insights on those, to that question.
I would say, oh, sorry.
Melody.
I would say for CIC, earlier they had some changes in the board. So it might be that shareholders were bullish to this information because of now the change of the strategy. Other than that, I haven't seen anything that, as you said, fundamentally that can make the price to rally. Wesley?
On Transcentury, I wanted to comment on the price function. It has had a general decline trajectory since mid-June, sorry. So there is something to watch therefore on the price function.
Okay, thank you very much, Churchill, Wesley, and Melody. Michael Mutiria is asking, is there any specific economic sector that is likely to receive increased attention or activity through FDIs, especially with the entry of the Egyptian lenders?
I would, oh, sorry, go ahead, Churchill. Oh, I just wanted to point out that now from these talks from the Kenya National Chamber of Commerce, they're looking mainly in financial technology and the processing of farm produce. So we've seen that the trade between Egypt and Kenya mostly is on agricultural products and also minerals, chemicals, plastics, so manufacturing and farming as well. Maybe Churchill can add something on that.
Thanks for that. I was looking at it broadly in terms of the specific sectors that will benefit, but thanks for your insights. So, because now for the banks, specifically now to that question, Egyptian banks getting into allocation to different sectors. So for me, I didn't see the Kenya National Chamber of Commerce angle. So I just thought that they'll just be able to disburse loans organically, because foreign direct investment is now different within the context of acquisition of banks or entry of banks by other say Egyptian lenders. So the FDIs is more the monies that now gets into more or less like equity injection into different sectors. The sectors that Melody has alluded to. But specifically for the lenders, perhaps they're just seeking opportunities into the regional markets. This is not the first bank that is coming. There's the previous acquisition of Mayfair by another lender. So this new lender, I think it's Egyptian Misri Bank coming in locally, perhaps just looking at opportunities, entry opportunities. So far, Kenya has been, in terms of regional diversification, we've seen entry of West African banks. So I think this is also a time or a right time that even the North African banks are seeing Kenya as a more attractive hub in terms of acquisition of the banking sectors. FDIs is a different ballgame, which may not even necessarily be through the banking that are coming from the different regions in Africa. There's some views around it.
Okay, thank you, Churchill. Titus Parsitao is asking, between Equity and KCB, which one has the strong fundamentals based on their recent corporate actions and business models?
So for the two banks, we are currently in the process of reviewing the models so that we can look at it better fundamentally. But each bank has its own different strategy that we've seen. We've seen KCB is now looking to go into Rwanda and Tanzania through its acquisitions of bank BPR and APC Bank in Tanzania. We've also seen that it's launched now its new Vuma platform that says it will be more efficient and better at pricing its loans. For Equity, we've seen also they acquired the bank in Congo, which now is generating quite a lot of profit for it. So basically, it's looking at both the strategies and how it's coming to play out, but we need to see how it will play out as the year moves on. But at the moment, we're still reviewing the models to find out like which one is more fundamentally prepared, more or less.
Okay, thank you for that. Linda Kirinya is also asking about KCB. What's KCB's percentage dividend payout after tax?
So looking at our Excel model, it's showing that it's around 54.2% dividend payout.
Okay, thank you very much. I think that's it. There being no question. No, there are more questions. Rachel Karuri is asking, when is it likely Kenya Airways shares will resume its trading after being suspended for 2 years now?
Let me take this one. I think the last announcement from Kenya Airways was around April or May, thereabout, one of those 2 months. So they now extended the suspension of trading for another 9 months. So you're looking at it to be reviewed either December this year or January next year. I don't remember the exact month exactly that 9 months is starting from. But having said that, the whole issue around the suspension was on that National Aviation Management Bill that was in Parliament. That was the crux of this suspension of trading, because there was a bit of some speculation when that bill was tabled, and that necessitated it to be suspended until that whole bill has been debated, has been fully debated. So far, we haven't seen much movement in Parliament in regards to that particular bill. The last time, I think it was tabled, first reading, and then it was now thrown out because there wasn't much input from public participants. So there was another tabling of the public participation, but you haven't seen the second reading. So after the bill has been tabled, so it has to go to the second reading stage. So second reading ideally is when Parliament now discusses the merits, the demerits of the particular bill before now it goes to the third reading, before that bill is actually passed or amended or rejected entirely. So we are still during the legislative stages. So far, I think we might be speculating by saying when it will resume trading, because this particular bill hasn't been fully ironed out. So we're still waiting, but we are just looking. We are in the 9 months extended suspension of trading of KQ shares up until early next year is when it can be reviewed, or if the bill has been passed through, which ideally was now looking at setting up this whole holding company, Kenya Airports Authority, KQ, and 2 other companies now being brought together, and that obviously will lead to re-nationalization of KQ, and then it will become delisted. So there are different uncertainties around this path, but at the moment it's suspended for 9 months.
Okay, one last question from Nelco Mose. Any views on Unga Limited? I think he was looking for a general answer. Churchill?
My colleagues, at the moment, I don't have anything around Unga Limited. I think the last time we had anything corporate announcement around Unga Limited was that proposed buyout. But after that, I don't know. I may be speculating, but let me not even comment further from that. So we don't have anything substantive around Unga Limited. Price action, we don't actively monitor it. But if it's something that Nelco would like to pursue, we can be able to engage him separately, or we'll be able to give much more flesh in our next presentation.
Okay, thank you very much. Now to the participants, we thank you very much for carving out your time this busy Monday morning to attend this webinar. And to the panelists, we thank you for your knowledge and how you explain it to us in a way that we understand. And also, should you want to buy shares, you can do them via your mobile phone. That is through our application called Jikuze, which is available both on the mobile Google App Store and Apple Store. And it's free to download. And you can register and start buying and selling shares. Should you also want to buy bonds? Yes, yes.
You forgot to mention that Damaris perhaps is not around today. And there's something that I raised a couple of months back. When a holiday falls on a Tuesday, and then there's a weekend before, or a holiday falls on a Thursday, there's something that happens in the intermediate days. That's on a Friday or a Monday. So yeah. Is it where Damaris is in today? Because in some countries,
no. I actually forgot even to introduce myself. My name is Daniel Ogeto. I'm in the marketing department. Damaris Mukulu is my boss, and she is, we can say she is behind the curtains today. And we always do this in turns. So today is my turn to take you through this webinar. So as I was saying, should you want to buy, rather invest in bonds or trading bills, you can maybe contact us via our social media handle, where we will direct you to our dealing department, and then you will be good to go. And other than that, I think I'd like to maybe say we should end it at this point. And thank you very much. Have a successful investing week, and may your decisions bring more happiness and value to you. Churchill, I see you laughing, but we can close it here. Okay, thank you very much.